Joining us right now to talk a little bit more about all of this is Komal Sri-Kumar, who is the president of Sri-Kumar Global Strategies. And Sri, what do you think on this entire debate?
Becky, I would agree with Stan Druckenmiller on that. I think that it is the Treasury's responsibility to lengthen maturities when the interest rates are low. Whether you are going to say it should have been Mnuchin or Yellen, the Treasury should have done it at a time at which the interest rates were very low. And even if they were to issue more for 10 and 30-year issues, increase the duration, they would have done the country and the Treasury a great service. They failed to do that. So I think there is no doubt at all in my mind that it is part of the Treasury's responsibility to manage the duration of the issues, and they should have done it.
I don't think different people at Treasury figuring that out. I'm not sure that economists are going to be the ones who are thinking of it from that same perspective.
But then the decision ultimately lies with the secretary. He or she is the head of the department in terms of deciding which way they are going to go. And it was just not done, Becky. I think that is a shortcoming.
But I guess, Sri, asking people to do that requires probably that they have pretty extensive market knowledge and market experience. And you can look at different Treasury secretaries. Mnuchin did have market experience. Hank Paulson's probably the best example of somebody who understood markets and was there at a very important time when things were freezing up during the Great Recession. Should the requirements for a Treasury secretary be different if you are asking them to basically be making massive market bets like that?
You
versus a John Snow.
Paul O'Neill.
Paul O'Neill.
Or John Snow.
Right.
John Snow.
Yeah.
Clearly, Mnuchin and Hank Paulson had a lot more market experience compared with Janet Yellen, but she also comes with a lot of academic background, number one, and she also comes after having been the Fed chair.
Right.
So I don't think the fact that she was not actively a portfolio manager before exempts her from having to deal with it and to deal with the maturities, Becky.
So I think of this kind of the same way as the SPR. Like, you want to run it down during times. I mean, should we be thinking about the SPR in such a way, or do we use the SPR just as an emergency valve that really should only be tapped during times of crisis?
I think your comparison is very apt. The SPR and building up oil supplies when the price is lower, and even if it means paying a lot of money in order to do it at that time, if we had done that in the United States, the oil situation actually would be much more comfortable. It takes a lot of courage. It needs foresight to do it. But very often the political decision is more short-term oriented and it fails.
And that's a fair point. The short-term political pressures on these things. It's just, I think of professionals who do this and get it wrong
all the time. And so
constantly.
then you're asking the government to do it, and when they get it wrong,
the private sector.
What would happen if we moved into negative interest rates?
And it's just, I mean, well, look at Japan. Sri, let's layer that onto this. What you heard from Japan today. We had Mark Mobius on earlier saying he thinks this is a move that was forced on Japan by the United States central bank, keeping rates higher, raising them faster, that everyone around the globe is going to have to follow suit, or their currencies are going to get crushed. What do you think of this move by Japan today?
The Bank of Japan governor gave that as an excuse. He said the Bank of Japan was forced to move because of the Federal Reserve and U.S. bond yields moving up. But what he, I think, did not mention or put enough emphasis on is that the Japanese inflation, and particularly the Tokyo inflation rate, has been much higher than anticipated. And there was expectation in the market that the BOJ would move a lot more than it did. It is now only a soft top at 1%, Becky. They thought they would totally give it up, which it did not yet. Another comparison, history-wise, the last time the United States tried yield curve control, you know where that was?
Where?
Late 1940s into 1951-52. We have not had yield curve control ever since in the last 70 years. And the reason is it doesn't work. And we did that in the late 1940s. The yield went up. Suddenly, the Federal Reserve found it could not support that interest rate, and they gave up. And the yield on the long bond, as it was called then, for the U.S. Treasury shot up. So yield curve control doesn't work. The Japanese government, I've been expecting for a while that the Bank of Japan would give up on this And I think today is the first move. There's going to be more coming from the Bank of Japan, and it will have an impact on the rest of the world.